Good evening, everyone, and welcome to the Brian Crombie Radio Hour. As you know, if you've been following my show, I like to show you some fascinating companies, and I've got one for you today. The CEO is Hugh MacNaught, and he has got a company that is a Toronto-based company. It's a medical diagnostic company. He's going to tell us a little bit about it, and I think it's a great example of a technology company that is launching an innovative opportunity, and he's struggling through the challenges that any kind of startup company, a VC company, has in raising money. I'm also glad to welcome back Pierre-Jean from Fournier Capital in Paris, France, that does fundraising for innovative companies. And we've had the pleasure of meeting him before, and he's told us about some other interesting companies around the world that have been out there really changing science, changing the medical world. Pierre-Jean, why don't you start out by telling us a little bit about the company and why you're excited about it?
Yes, I'll certainly going to do so. Just 2 minutes on giving you an update on my investment bank. So the name is Fournel Advisory Life Science. We are dedicated to healthcare. I created this investment bank 3 years ago. We have now 50 partners all over the world, mostly in the North America. That's how we encountered this company with Hugh. Also, we have about 35 deals on the market now. So we've got great market penetration. And I can tell you that this opportunity is one of the best I have in my portfolio.
Excellent. And tell us about the company that we're talking about tonight, Ventripoint Diagnostics.
Yeah, it's about imaging. It's about diagnostic of the heart. And the beauty of the system is that it uses artificial intelligence to transfer echo signals into 3D dimension of portion of the heart. This is just amazing because the cost of the equipment is south of 10% of an MRI. So we can tell already that the GE Healthcare, the Siemens of the world should better talk to us.
And Hugh MacNaught, thank you for joining us. I understand that you have raised over $1 billion, or you've played a role in creating in excess of $1 billion in shareholder value. You've served as the director of several different private corporations and not-for-profit agencies. You've been on the Technology Commercialization Committee for the Alberta Heritage Foundation for Medical Research. You were on the board and audit chair of Genome Prairie, and you currently sit on the core evaluation team for the GAP program of Genome Canada. Wow. And then you decided to launch your own company, Ventripoint Diagnostics, several years ago, and you're now the CEO. Tell me about your history, sir, and Ventripoint.
Thank you, Brian. Yeah, so I really regard myself as a generalist. I set out purposely in my career to build that skill set. So I've taken a number of roles in key areas that include research and development, sales, marketing, finance, and general management. Initially, I did this with multinational companies, which provided me, the opportunity and the venue both nationally and internationally. With regards to technology and product focus, my experience encompasses drugs, diagnostics, and medical devices, many of which have been related to cardiovascular disease and disorders, and that relates to Ventripoint Diagnostics.
Now, I understand that this is a company spun out of the University of Washington, and what you're doing, we've heard a lot about AI of late, of long too. What you're doing is you're somehow applying AI to cardiac diagnostics. Can you explain that, please?
Yes, the genesis of the system was a cardiologist at the University of Washington in Seattle who was caring for pediatric patients with congenital heart defects. She had concerns about subjecting these kids to MRIs. So MRI for the heart, cardiac MRI, is regarded as the gold standard. However, it's not recommended for children or patients under the age of 12. Patients need to be stationary. They need to keep still while going through the procedure. However, they might be claustrophobic or nervous, or being children, just fidgety. So therefore requiring sedation. They may require contrast media, which is injected into them. And in many cases, the parents cannot be with the patients. So for a number of reasons, MRI really is despite being the gold standard, is not really desirable for children. So she was looking for an alternative. Her idea was to apply AI to cardiac ultrasound or echocardiography. MRI is somewhat of a precious resource. The installed base of these is not a great number. In the case of echo, though, it's everywhere. The installed base is tens of thousands of units. So her idea was to apply AI to echo studies to generate images or data of equivalent quality to MRI. And the way we do this is that we built up a very carefully curated data set or image library of thousands of MRI images of the heart. On top of that sits a number of proprietary algorithms. So really, our system is taking an echo study and going back to a source which is comprised of gold standard images and then reconstructing 3D shapes of the heart. So from these shapes, they can report the volumes for each of the four chambers of the heart and what we call the ejection fractions, so a measure of how efficiently the heart is working. We can do that for all four chambers of the heart, and we are particularly unique in terms of our ability to characterize the right ventricle of the heart. So the right ventricle is a very complex shape. To our knowledge, we're the only company that is able to reconstruct this.
So, my understanding is that with AI and large language models, what you're doing is you're taking some information and predicting what the next information is going to be. And so what you're doing, I take it, is you're taking some information from the electrocardiograph and you're sort of predicting what the balance of the heart or the ventricle looks like based on the information that you've got. Is there a risk of false predictions we've heard lots of these stories in AI of errors. What's your confidence in the accuracy of what you're doing?
Our confidence is very high, and in fact, to get into the technical side of this is really more machine learning than generative AI. So we're not generative AI. This is a static database. Our system is creating a mesh image of the heart based on identifying certain anatomical features. The users have the ability to oversee this, and so it's really very accurate, very, very consistent, sort of study to study, and it is backed up by gold standard MRI images.
And so, I understand this would be for people with congenital heart defects, cancer patients. Tell me what some of the patients are, some of the disease states that would occur that would be, helped by your technology.
Yeah, so we really began, as I mentioned, with congenital heart defects in children. However, a good number of these patients are surviving well into adulthood. In Canada, there's approximately 300,000 patients with congenital heart disease, both children and adults. In the US, that's 1 million children and 1.5 million adults. So these patients are surviving well into adulthood. This is largely due to better treatments and procedures. As they go through their life journey, a number of these patients need to be monitored, particularly in the case of females, as they grow into adulthood and then perhaps become pregnant. That places additional stress on the heart or strain on the heart. They need more careful monitoring at that point. So that's one area of interest for us, and is a core sort of competence, if we could call it that. Another is cancer patients. So a number of chemotherapies are actually toxic to the heart. So these would include drugs like Herceptin, which is commonly used for breast cancer. So these patients need to be carefully monitored during their courses of treatment. Other areas are heart failure, pulmonary hypertension. And right now, we're very excited about the opportunity to provide a solution for valve procedures. So heart valve procedures is a very dynamic area right now, growing rapidly, and the standard of care is improving, year by year.
So my own son had an issue with the aorta, and I guess it collapsed, and we didn't know what was wrong with him. He was rushed by helicopter to Sick Kids in downtown Toronto. And it took a long time for them to figure out what was wrong with him. And then finally, they came to the conclusion that he needed to have angioplasty into the aorta to fix it. Is that something, you're talking about congenital, issues with the heart and problems with the ventricles and the valves. Would your technology have potentially helped him?
Potentially, if the defect was close enough to the heart, absolutely. We're not a solution that looks at artery disease per se, but where the artery is very close to the heart, absolutely. And this is another area that's been suggested to us that we need to focus on.
And so is your product a software program, or is it hardware? And what is the hospital or is it a hospital that's buying your technology? And what is it? Is it a program or is it a hardware?
It's a combined hardware and software solution. So the product is provided right now as a medical grade tablet on a wheeled stand, and two small sensors that are used, one on the patient, one on the ultrasound transducer or probe. So that's the core of the system. We also provide a workstation solution that is software only.
And what's the approval process? Is this like a medical device that needs like a 510K approval, or what kind of approvals do you need?
That's exactly what it is. So we have a 510K clearance in the US and CE marking for Europe, the UK, and elsewhere that rely on that marking, plus a Health Canada medical device license.
And have you already received these approvals?
Yes, we have. We're now on the fourth version of product, and the most recent version has been cleared for sale in all of those markets.
And so to get that approval, did you have to do studies with numerous different people to prove that your product works?
Yes, we did. So we needed to rely on a number of cardiologists, so sort of experts or key opinion leaders in the area, plus a number of patient studies. So that took approximately a year to work through the process.
So, many of the companies that PJ introduces to me are sort of development stage and pre-revenue. You're approved. You're actually creating revenue.
Yeah, so I've been at this for a couple of decades now with early stage companies, and this one is very unique insofar as the product is in hand. There essentially is no regulatory risk. So we're now positioned really to move this company into the growth phase. So this begins with luminary sites like SickKids in Toronto. So SickKids is one of the top 2 pediatric hospitals in the world. So they're a user, St. Michael's in Toronto. And as well, we have a couple of dozen other sites worldwide that include Mayo Clinic, Duke University Hospital, La Charité in Berlin, Erasmus in Rotterdam, and others.
I didn't realize Toronto SickKids was one of the 2 top pediatric hospitals in the world.
Absolutely, yeah. It's quite a remarkable center.
That's a great testament to SickKids in Toronto. Thank you so much for mentioning that. I didn't know that. We're going to take a break for some messages and come back in just 2 minutes with Hugh MacNaught and Pierre-Jean Fournier, talking a little bit about technology and innovation, as well as the exact company that Hugh is the CEO for. Stay with us, everyone. We're going to come back in just 2 minutes and talk about the challenges of raising money for technology companies in Canada. Stay with us. Welcome back, everyone, to the Brian Crombie Radio Hour. I've got Hugh MacNaught with us tonight. He's CEO of a Canadian-based technology company. We're going to talk in a couple of minutes more about the company and the disease states that he's trying to address. But I wanted to take a step back. We've also got Pierre-Jean Fournier, who runs an investment bank out of Paris, France, but very representative in North America as well as across Europe and around the world, about raising capital for venture stage companies, because Hugh, it sounds like you've been doing this for a couple of decades. I've been in the pharmaceutical business. I've been in the medical device business. Lots of people say Canadians are pretty good at creating stuff, but we're not very good at commercializing. And one of the reasons why is because we can't get the money, the VC money, or it's challenging to get the VC money to grow companies into the commercial stage. Some people think that, too many Canadian companies either have to sell themselves to Americans or go down to the United States and recreate themselves in the United States, or get off the Toronto Stock Exchange and go down to the NASDAQ or the NYSE. So tell me what your assessment, sir, is of the challenges of raising money for technology stage companies, particularly in the health sciences field in Canada.
Yes, it's a very challenging environment to raise capital in Canada. Ventripoint is a publicly traded company. We're on the TSX, ticker VPT. Uh, we've been able to raise a certain level of capital, probably insufficient really to go the ultimate distance, but enough to get the technology to a reasonable state of development. This was proceeding reasonably well up to COVID, and of course there was quite a bit of chaos both in the healthcare markets as well as capital markets during and following COVID. So the situation we find ourselves in now is investors have been reasonably risk off, and just reluctant to commit large amounts to early stage companies. So this is slowly changing, but has been an ongoing challenge, and definitely Pierre Jean has been a godsend to us in terms of amplifying our outreach. So access to capital in Canada, is a challenge not just for Ventripoint, but for all early stage companies. Also, access to experienced management is a challenge in Canada. So the depth of the talent pool is much more shallow than in countries like the US.
So why don't you move to Silicon Valley or to the New Jersey pharmaceutical sort of nucleus?
Well, partly because I'm a proud Canadian and I would like to grow a success story in Canada. As well, despite our challenges with accessing larger amounts of capital, I do believe that development is much more efficient in Canada. So definitely the dollar goes a lot further up here. So I think we can do as good or better a job in Canada, probably on less capital, less dilution, and delivering a better return to investors.
So the pitch that the University of Toronto provides, as well as Mars, which is the medical advanced research, whatever it's called, there at University and College, is that we've got more medical establishments on University Avenue than almost anywhere else in the world. And that Mars really tries to be a incubator for and an innovation hub for medical research, such that we're trying to create a cluster, a ecosystem that will help companies like yours, both with a management standpoint as well as an innovation standpoint, in being successful. Is that a false pitch, or is it accurate?
I think that's accurate. Definitely we have world-class universities. I think there's a very high awareness of the need to commercialize the outcomes of research, good patent activity, et cetera. However, again, forming these companies, raising a couple of $1 million to get them going is probably almost exactly enough money to get themselves into trouble. So the creation of the companies, I think we're good at, but the challenge really comes into what follows. So how do we raise larger amounts of money, so maybe an order of magnitude more money, and bring in the executive teams to really make these things fly?
So I was the chief financial officer for a sizable pharmaceutical company, raising money in Canada for a Canadian pharmaceutical company. And we found that, when we went on a road trip to pitch to Canadian investors, we often were introduced to the special situations analyst who was responsible for, those things that didn't fit into any other area. They had a mining analyst, they had a gold analyst, they had a food and beverage analyst, but they didn't have a medical research analyst or a biotech analyst. But we went to Silicon Valley, or we went to New York, or we went to Boston, and those big institutions all had, someone that had a master's or a PhD in something medical or scientific, and they really focused in on and knew what they were talking about, and had the opportunity to ask really good questions. Is part of the problem that we're just so thin that we don't have that expertise within the institutions in Canada?
Partly that's it, yes. And I think if you look at the financial industry in Canada, definitely there's been considerable consolidation. I think in terms of managed wealth, that the offerings are really consolidated now down into a number of fairly selected offerings. So looking at risk profile, I think they're very conservative, and things like healthcare and early stage technology probably just aren't a fit. And as well, as you mentioned, it's looking at the depth of expertise of analysts, or the willingness of the institutions to hire and retain these highly skilled people.
What about conferences? There was lots of investor conferences in New York and San Francisco to attend and pitch at. Are there any good conferences focused on health sciences and biotech and medical devices in Canada that you can attend and get to meet and pitch to investors?
There's a select number, yes. So one of them again in Toronto would be the Bloom Burton conference. So that one is very good. There's a couple more, but otherwise, really for that type of activity, we need to go outside of the country.
I had a venture capitalist that came on my show from a company that specializes in high tech investment, not therefore biotech. But he said one of the biggest challenges is that the real estate market for the last decade had been so positive and so many people had made so much money in investing in real estate that it sort of crowded out equity investments in more productive, innovative parts of the economy. It was interesting. He criticized real estate as being too good for the last decade, not today, but for the last decade, and said that was the problem, that people sort of took the low risk opportunity to make money on real estate rather than investing in high tech. Is that part of your problem?
I think that is. And actually, I had read a commentary from a foreign economist who described the Canadian economy as a real estate scam with a side hustle in oil and gas. So, yes, I think that
real estate scam with a side hustle in oil and gas. Really?
Yeah.
So tell me also about raising money on the TSX versus NASDAQ or the NYSE.
Yeah, so the TSX, we have a fairly large and very passionate cohort of retail investors. Many have been following the company for a good number of years. I think looking for not only a financial outcome, but believing in the potential of this product to save lives, or at least improve the lives of patients. In the U.S., we're just dipping our toes into those waters, so getting a better feel for both retail and institutional investors down there. Definitely, I think it's going to be a case of developing a profile with the analysts, and also having a compelling story to tell versus the many other opportunities that our investors are looking at.
Well, part of the compelling story has got to be that you're actually approved and you're creating revenue, which is, my experience, sort of pretty unusual. There's so many development stage companies that are, if not pre-revenue, pre-EBITDA, and so therefore the fact that you're producing both is pretty spectacular.
Oh, absolutely, yes. I think we've got a great story to tell, and I think as awareness grows, that there'll be increasing receptivity to it.
Some people have also said part of the challenge is that the government hasn't played the role that it could and should. People talk about shreds as being overly red tape and bureaucratic and very difficult and time consuming to get science research development grants, and that we support oil and gas and mining companies with flow through shares and real estate companies with REITs that allow people to access pre-tax earnings in other sectors, but we don't provide that kind of an opportunity in high tech or biotech. What do you think? Is government part of the problem here?
I think it is. Definitely I'm not a fan of corporate welfare, as some people call it, but I think government does have a role to play. In fact, in terms of flow through shares, I'd embarked on an initiative 20 years ago to talk to government ministers about the need for things like flow through shares, and was informed at that point that government doesn't subsidize industry.
But they do. They do in mining. They do in oil and gas. They do in other sectors.
Well, exactly. So, it was a very interesting conversation at the time, but just not a receptivity to extend those sort of mechanisms to healthcare. So that's one area. As you mentioned, shreds are fairly cumbersome. We're going through an application process right now, and we've been 3 months into it using external consultants. So, definitely not an efficient process or very fast. And then finally, I think looking at application of the technology, there are real benefits to employing technology such as Ventripoint's VMS. And certainly it would be very helpful if Canadian institutions were at the front of the line in terms of acquiring the system and using it. So really taking Canadian technologies, and engaging in innovation in Canada using those technologies.
Well, if you've sold to sick kids in St. Mike's, you've certainly made a major step in that regard. Pierre-Jean, maybe I could turn to you for a second. You obviously help Canadian companies. You've introduced me to a couple of other Canadian companies over the years, but also companies in the United States and in Europe, and you've introduced me to companies in Israel. Tell me, if you could, what your sense is of the challenges and the opportunities for raising money for venture stage companies in Canada in the healthcare sector.
With pleasure. One general comment, and then two solid and personal experience. We published last month a 3-year analysis on fundraising in the world for life science company. What's amazing, our findings, for instance, it uses now, do you know how much time does it take on average for any biotech on average in the world to raise funds? Do you have any ideas?
No, a long time. When I was doing it, it was
my friend,
it was the majority of my job.
22 months. It's just amazing. We took the mandate in Canada that we're talking about with Ventripoint for two personal reasons. The first one, as you know, I got metastatic cancer, and I got resurrection. My lesions are increasing on my lungs, and we did an MRI because other instruments would not be able to have this level of analysis. We're talking small lesions, and I had to wait. Several weeks, although my situation was kind of important. So the implication of using MRI as a golden standard is that the hospital needs to make a huge investment. As a result, there are not enough of them, which is one of the key elements of the value proposal of Ventripoint. Because when you spend not even 10% of the required investment against the golden standard, well, you definitely make a point. The second point, I had my MRI last week. They could not see a thing in my lungs when a PSMA PET scan, which is another form of scan, could see it. So yes, MRI is the golden standard, but I took it as a challenge to demonstrate to investors that's the way to go.
And tell me, how do you compare investing in and raising money for companies in Canada versus in the United States versus Europe?
Well, talking dilutive investment or non-dilutive investment, it is clear that non-dilutive investment like debt, like bonds, very hard to find in Canada, in the world of healthcare. I'm not even aware of a significant player in Canada. Now, if you talk about the US, we work with about 20 of them. They got huge money and they provide solutions to startups, to healthcare companies, which is kind of interesting because we're talking non-diluting the companies. So on the non-dilutive investment, bonds, FRNs, high yields, debt, Canada doesn't have the solution that they should have. You have a large player on the East Coast, Caisse Desjardins, that everybody knows about, but that's one of the few. So that's the first thing. The second, the size of the funds in Canada are too small. As a result, when they raise new money like $50 million, they can only inject $3 or $4 million on every transaction, which is not a good thing. So yes, there's ways to improve fundraising in Canada.
Maybe you could explain, if you could, PJ, to everyone, what non-dilutive and dilutive financing is and why the benefit of non-dilutive financing.
Of course, but before I do that, let me surprise you, which is always a challenge to surprise you. I have prepared 3 surprises at the end of the presentation that should make your people attending the call very happy. Now, responding to your question, dilutive means basically that you issue new shares, and as a result, the previous shareholders will end up with less control of the company. Now, if it's non-dilutive, like a loan to the bank, there is no impact on the capital structure. So if you own 10% of a company that issue a debt, you maintain your 10%. That's the major difference. Now, on this market, healthcare market, it's a very particular debt. We call that venture debt. And for instance, the coupon, the interest rate is very high. We're talking 18, 20%. Some warrants attached, but that's not the important thing. So it's very expensive, and it requires research, as you mentioned, within these funds of PhD, more than financial guys, because they're going to have the same view as dilutive funding, equity raising. You need the same profile. It's different type of funds, but after all, they have the same processes.
Thank you for that. We're going to take a break for some messages and come back with Hugh MacNaught and Pierre-Jean Fournier in just a minute, talking about this equity raise. And I want to sort of go through some of the metrics so that all of you understand whether you're interested in Hugh's company or not. Some of the challenges and some of the different terms that you need to be aware of. Stay with us, everyone. Back in 2 minutes. Welcome back, everyone, to the Brian Crombie Radio Hour. We're chatting tonight with Hugh MacNaught. He is the CEO of Ventripoint Diagnostics. It's a Toronto-based, Canadian-based company that's got an interesting technology. He's out raising money right now, and he's actually got approvals. He's got a 510K approval, which is what medical devices have to get to sell their products in the marketplace. He's sold to, I think he said, Sick Kids and St. Mike's hospitals in Toronto. And so, unlike a lot of companies that I've looked at and that I've been introduced to before, he's actually post-revenue, not pre-revenue. He's out there actually selling products, which is fantastic, and he's got those approvals. And we've also got Pierre-Jean Fournier, his investment banker from Fournier Capital in Paris, France, who's going to tell us a little bit about raising money and some of the challenges of raising money. Hugh, what's the ticker symbol for your company? What's the website for your company? What's the market cap for your company, please?
So the ticker is VPT. We are on the TSX V, as well as the OTC market in the US. Market cap right now is approximately $25 million, 200 million shares outstanding.
And the website?
The website is www.ventripoint, so VENTRIPOINT.com.
Excellent. And how much are you out trying to raise?
We're currently seeking $5 million US.
So your market cap is 25.
Yes.
And you're trying to raise 5 million.
Yes.
Okay, so that's a significant dilution to current shareholders. Tell me how people are thinking about that.
Yeah, I think that actually hangs together fairly well. That's a dilution of less than 20%. It will steer this company into the growth phase and get us to a positive cash flow. So, I think overall, investors and potential investors will feel that this is an appropriate level of dilution and actually gets the company to the point of self-sufficiency.
And what's your use of funds for that 5 million? What are you going to spend the money on?
There's a very heavy bias on marketing and sales. So we'll continue to engage in a certain amount of R&D, but really that is more focused on integrating our product better or more efficiently into clinical workflow. So really the primary application of this is marketing, sales, and business development.
And what are your revenues right now? What were your revenues for either 24 or what are your estimated revenues for 25?
Yeah, our revenues have been below $1 million, so fairly modest over the last couple of years, but we're looking to obviously get above that threshold and then move into geometric growth.
So probably no PE multiple, it's a revenue multiple that one would have to look at.
Yeah, so I think at this point, really, it's looking at the market potential rather than basing this on revenues or profit.
Right, and how widely distributed are the shares? Do you control most of the shares, or are they widely distributed?
They're very widely distributed. So we've been told that there's probably in the order of 10,000 retail investors in this. Daily trading is probably in the neighborhood of 300,000 shares.
So it's fairly liquid.
Yes.
Now, one of the ways that some people in your state would raise money is with the use of warrants. Have you used warrants at all?
We do, cautiously. Over the last year, we've been raising money primarily through convertible debentures. In this case, I think we'll be pursuing an equity raise. PJ can definitely speak more definitively to that. So warrants are a mechanism. However, we're very careful in terms of attaching those.
Can you explain to everyone what a convertible debenture is and how much you raised under convertible debentures?
Yeah, so convertible debenture is technically it's a form of debt. So, over the last year, we've raised approximately $3 million. The features of this are that at some point it does convert into equity. So right now, if the share price was 15 cents, we would pay a 10% interest for sake of discussion. And at some point in time, there would be a conversion to equity at a higher price. So that might be at 25 cents. So as the share price increases to a certain level, then the conversion would occur, and these debt holders would then become shareholders.
So 10 cents of a premium on top of a 15-cent share price, that's a fairly sizable premium before it converts. How do you think through with those bankers that are tough like PJ? What's the appropriate premium on that convertible debenture?
Well, that is a negotiation. I would also say that one of the features of our convertible debentures are that the conversion can occur at the election of the holder. So at any point, they can elect to convert this to equity.
I think the real benefit of converts is that in the downside, you've got debt and you've got an interest payment that you're going to get, and the upside is if the things work out for your company, you got that opportunity to convert, albeit at a premium, into the equity of the company, and so therefore you got the upside opportunity, albeit not 100%, you're limited by the premium, and you've got the downside protection, and so therefore converts are a really attractive way for cautious investors that want to participate in VC opportunities, venture capital opportunities, to invest. Do you agree with that or not?
I do, and I really view this as a win-win. So it provides that assurance to investors. A 10% coupon on this, I think, is attractive in today's environment. As well for the company, I think it brings in a type of investor who's in there for, the medium to long term. So not day traders, but people who are actually interested in seeing the company advance towards its goals.
I also like warrants for that reason, because I think what it does, it sort of often doubles or triples your upside without increasing, again, your downside, because you're not having to risk that money right away. And so therefore, when you think about it, I've got a certain amount of downside, the amount that I've invested in the equity right now, but I can magnify my upside if I'm really excited about the company. But you said that you wanted to judiciously limit your amount of warrants. Why is that, sir?
Well, it's just really managing the dilution. So I think warrants can work, absolutely. But, in a way, it's a form of currency. So we just need to be judicious about the use of them.
PJ, maybe we can turn to you. Tell me about, how you as the banker think about pitching Hugh, the CEO of the company, on the use of convertible debentures and the use of warrants. Because as I've just described it, I think from an investor standpoint, both of them are pretty attractive because they limit the downside and they magnify the upside, which I think is the biggest challenge that a lot of investors in early stage companies have, which is I'm willing to put some money up, but I don't want to lose my capital. But I do want to play in that upside.
Well, so rightly put, like always, yes, everything that's been said is completely true. The reason why I signed up with Hugh also, to tell you the truth, is that our research that we've performed and published last month demonstrate that, yes, it is still difficult to raise funds, be it convertible, be it shares, be it debt. And how we responded to that, and we did that with a lot of clients over the last 12 months. We come to them and we say, okay, you need to fundraise. Here is our ideas, convertible, equity, debt. But what we'd like to do with you guys, with your board, is to explore two other avenues at the same time. One being a business development arrangement with a large medtech company, and the last one being a pure M&A transaction. I cannot tell you more because it's a listed company, but we tend to have, I would say, 90% of our clients now to accept this triple track solution because we multiply the chances of success. And when the market is not there in terms of fundraising, we find an option that works. And I'm very proud to say that we signed yesterday, on Friday, a $10 million investment in a startup in Canada. So using this precept of using this strategy of having three dimensions in responding to the need of funds. So that's the way I see it.
Hugh, I faced this situation, and actually PJ is very familiar with it, where we had a a pharmaceutical product that we wanted to launch, but we were a Canadian company. We didn't have a sales and marketing arm. And so therefore we went out and looked at the opportunities to do M&A transactions or licensing transactions with major pharmaceutical companies that had large sales organizations in the United States that could have marketed the products. And we didn't have, great traction. They were all trying to take advantage of us and offering us single-digit kind of royalties. So we went out and we bought a U.S. sales and marketing function. And as soon as we did that, so we actually had the ability to self-launch. Then the big guys came to town and started thinking, oh, maybe I'll pay you what you deserve. And then we ended up licensing the product for a double-digit royalty to the big company. And so we had to go with that double-track strategy and look like we were actually very serious about going down the self-launch strategy before we could get the big guys to pay what it was worth. So is that at all what you're doing right now? Is you're trying to prove that you can sell those products yourself? But I'm open to it.
My read is that finance it's about work more than anything else, not innovation. So I'm just going to give you an example. In 2020, a firm specialized in DDS in the UK, Hemisphere, was listed in the UK, signed a business development agreement with Novo Nordisk. This technology gave to Novo what became Ozempic and made Novo the first market cap in Europe. How did they structure the deal? It's public domain. Number one, minority interest into Hemisphere, the provider of technology. Number two, a co-development arrangement whereby clinical trials were paid with a premium of 20-25%. And then the third one, which is the royalty business that you mentioned, which is huge, or an M&A transaction attached to the transaction. So I'm not inventing anything. It's on the market for a long time, and you just had this testimony on your side. Yes, that's the way to go, to use all examples and make them work on the market.
Do you get those kinds of questions in your investor meetings, Hugh?
Yes, amongst others. Absolutely.
What are the big questions that you get from investors, sir?
Well, I think right now focus is very much on sales. So, investors are interested in the sales process, what the outlook is. In the early stage company space or the venture space, the word disruption is used quite a bit. In this case, I think for the major companies to really be disrupted, there has to be evidence that we're shaking things up. So we've got to get out there and sell a product. So really a lot of the questions are around that. What's the process? Who's doing it? How does it scale?
One would think that selling to major hospitals has a fairly long selling cycle. How many salespeople do you have, and what is the selling cycle?
Yeah, right now we've got 3 salespeople plus an executive who's coming on board. As well, we work with distributors in the UK and EU. Sales cycles have been pretty long, at least 12 to 18 months, but I'm happy to say that we're in the midst of it, so we're not starting from square one. Also, we're changing our business and revenue model to that of a subscription base, which we feel will reduce a certain amount of friction and shorten the sales cycle.
So, historically you sold upfront. Now you're going to sell over time by way of a subscription?
Yeah. So before it was a capital equipment sale. And when the price gets above certain thresholds, then you're into hospital budgets and, a considerable amount of bureaucracy. By moving to a subscription model, we're below that threshold, so decisions can be made faster. It's also nice for the company because that really builds in a stream of recurring revenue. And for a product like this, once it is adopted into routine clinical use, there's a high degree of stickiness. So we would not expect to see a significant amount of churn in the customer base.
Well, once you get that subscription model working and you prove out that revenue, you're going to be able to go to PJ and get non-dilutive financing against that recurring revenue. So good luck in that regard, sir. We're going to take a break for some messages and come back in 2 minutes with some concluding comments with this fascinating Canadian innovative company. Stay with us, everyone. Back in 2. Welcome back, everyone, to the Brian Crombie Radio Hour. We've been chatting with Hugh MacNaught, CEO of a really innovative Canadian company. Hugh, what do you want to tell us as a closing comment about what investors in Toronto should be thinking about in regards to your company, sir?
Yes. VMS, Ventripoint and its VMS system represent the culmination of 20 years of progressive development. We have a very promising and exciting product that really will, extend the lives of a number of heart patients. So the development is in hand. The regulatory risk has been driven out of this. We're now really focused on gaining traction and achieving growth. We're raising capital to support that. And at this point, I think it's a very interesting investment thesis and opportunity.
Remind us the ticker symbol that we can check out if we're interested, and the website we can go to get information about your company.
The ticker symbol is VPT on the TSXV and OTC, and the website is www.ventripoint.com. Thank
you so much. And PJ, Pierre-Jean, you said you had some surprises for us. What are they, sir?
You'll have to wait for 30 seconds. My last argument on Ventripoint is simple. It's at the core of my strategy in my investment bank. It's about saving life and make money. If possible, a lot of money. Now,
saving lives and making money. That sounds pretty good.
I will refer back to Wall Street. You remember when you say greed is good. Okay. First item for everyone, Christmas is not there, but my last book has been published the day before yesterday, and it's about finance for dummies, and it's talking about the intricacy of how I got the most important deals of the 90s against Goldman Sachs. A lot of fun. The second, we're starting production on my film. It's going to be about bipolarity, and it's going to be fun and emotion. The last surprise is for Brian only. I would like to host Brian on the next presentation.
Fantastic.
What do you think?
Pierre-Jean Fournier of Fournier Capital, Paris, France. Thank you so much for joining us. And Hugh MacNaught from Toronto. Really appreciate it. That's our show for tonight, everybody. Thank you for joining. I guess if I could finalize with one word or one sentence, it would be, I like PJ's save lives and make money, but I think more importantly, it's grow Canadian companies as well, because I think what Hugh has described is a really interesting, innovative opportunity. And these are the kinds of companies that we want to have in Canada. We want to congratulate for staying Canadian, and we want to incentivize to hire Canadians, to invest in Canadian manufacturing, Canadian innovation, etc. And so therefore, take some of your scarce dollars that you're going to be investing in the stock market and think about companies like Hughes, and to do the research. If they've already got the approvals and they're all already post revenue, that decreases the risk fairly dramatically. And think about, warrants, convertible debentures, and straight equity, and giving that money, giving some of that scarce capital you got to smart guys like Hugh to grow great Canadian innovative companies. Anyway, that's our show for tonight, everybody. Thank you for joining us. I remind you, I'm on every Monday through Friday at 6 o'clock on 960 AM. You can stream me online at www.saga960am.ca. You can get all my podcasts and videos on my website, briancrombie.com, and you can also get them on YouTube and social media and podcast servers as soon as the radio show goes to air. Good night, everybody. Hugh, PJ, thanks so much for joining me.
Thank you very much. It was a pleasure.